All right, everybody. Welcome to today's class. My name is Jeff Gibby. I'm going to go ahead and kick us off. Just realized that I didn't start the broadcast. So if you can hear me, go ahead and click on or type in Y. That way we can know that we're actually broadcasting now. And so we'll go through the legal disclaimer again, but this time with you guys listening. So welcome to today's class. Today's demonstration is designed and instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. I feel like I just said that. Anyway, welcome to today's class. Really appreciate you coming out here today. Let's go ahead and make sure this is projecting and playing and all that kind of good stuff. So I want to talk a little bit about our host, Roy Swanson. He's a veteran trader. Really like Roy. Kind of was introduced to him late last year, and the thing I really like about Roy is he uses the same indicators that I like to use in some of the trading that I do, the RMO indicators, and he's got a very interesting and methodical take on the way he uses the RMO that's kind of refined him quite a bit. So he's a frequent guest. We'd love to have him, and he does a great job. So let's go ahead and get him on, shall we? All right, Roy, are you with us?
I'm with you, Jeff. Can you hear me?
I am. You should have presenter controls right now.
Okay. And can you see me?
I can see it. Yeah. Looks like it looks like you're using Windows 7. I'd recommend probably that you maximize the PowerPoint.
Maximize that?
Yeah, just yeah, that looks perfect. I'm gonna go ahead.
Actually, I'm using XP.
Oh, that's right. That would be XP. I downloaded 10 last night. I haven't used it yet on my home PC. So
I'm about to go to 10.
I like the price on it this time around.
Yeah.
Well, anyway, Roy, anything you want to add to the introduction?
No, I guess I'll just get going. Thanks, Jeff. And I want to thank everyone for coming. Thanks to Jeff and MetaStock for hosting me. We're going to talk today about where are the gains in today's market. A lot of people are sort of struggling to find gains, and we'll start off, though. Again, we have to start off with our own disclaimer, and I have it summarized. We're not brokers or certified financial planners. All the results we post here are illustrations based on simulated historical trade results. Past performance on this or any trading system is not indicative of future performance, and the information presented here is solely our opinion and intended to stimulate your own explorations regarding trading. So today's agenda, real simple. I want to keep it simple. It's summer, and our heads are all spinning from what the markets have been doing. But the real question is, where are the gains in the new market patterns of 2015? And at the end of the presentation, I will be letting everyone know how they can get a copy of my book, Read This First Before You Buy Stocks. All the information I present here really came out of the due diligence I had to do, the research I had to do to write this book. It's a Kindle book up on Amazon, but we'll be, again, letting you get it for free at the end of the session today. A little bit about me. Basically, I've been trading for 20 years. I started in the 90s when online trading started. Shortly thereafter, I was actually on the phone with DL&J, one of the early online brokers, talking about working for them in derivatives, but decided to turn that down. I didn't really know that much about derivatives, and I weren't sure they would catch on. But anyway, I did go on to be a consultant to quite a few trading educators and trading system providers, and along with my partners at Steady Trader, we have about 25 years experience really on developing and fine-tuning trading systems. So we know a lot about strengths and weaknesses of trading systems. And more to the point, we know why traders have trouble even with good systems, and we'll touch on that a little bit today. Now, my first couple slides, I just want to go over something which I go over in almost every presentation, and I do like to talk about the fact that the market has changed. And the media doesn't talk about this a lot, but you know, we all know what the old market was, and that really ran from the Great Depression basically up to the 1990s when I started trading. And that was the market of fundamentals and buy good stocks, and good stocks will take care of you. Then something happened. I call it the change. I call it the market of dreams. It's when you really you couldn't help but make money. It was especially in the late 90s. But that created a lot of misperceptions. What we ended up with is the new market, and the new market is quite different from the old market. In other words, you don't have to be a rocket scientist to see that the patterns are completely different with the new market, and yet an awful lot of strategies and trading habits are still based on old market patterns, and that's a little bit also what we want to talk about today. The media is absolutely old market. I call them delusional in many ways, the financial media. Article and article after fundamentals, article and article about the news. And yet, I think we all know the reality of the markets today. 80% of the volume is high-frequency algorithmic trading. You know, milliseconds to seconds, and you know, where are fundamentals in this kind of trading? Well, my opinion is they have really no bearing on the market today. Same thing with news. In this reality of high frequency trading, the media is just talking about stories to get people to tune in, read stories, sell their advertising. And then the other big reality is that 80% of the markets trading is done in dark pools and private markets. We saw that evidence of that a couple of weeks ago when the New York Stock Exchange actually went down for 3 or 4 hours and nothing really happened. That's because it's only 20% of the volume. So, you know, all this talk about pretending to analyze companies and fundamentals and news is really just a lot of window dressing, and it's really just about, it's the media business. It has nothing to do with trading, nothing to do with financial analysis. So let's talk a little bit about trading the new market. The first thing is that the market is slowing down. I mean, we know that. The S&P 500 was up 12% in 2014. Year to date, it's up about 2.5%. So the volatility, though, and this is the good news, is the volatility is basically okay. You need volatility to make money trading, especially trading on a regular basis. The volatility you can see here, it's roughly the same as it was last year. So there's plenty of movement in the market, even though it is very much range bound. So where are the gains? Well, again, we know the market has been almost flat, and it's been range bound basically between 2050 and 2150, 2125. But I want to call your attention to the bottom bars here, and these are the changes in the overall bias of the market, which I think are essential to understand. The market is basically changing direction every few days. In fact, the longest run you can see here, 4 days here. I think we had a 4-day run here going down. It's basically almost every other day in general, but every 2, 3, 4 days maximum, the market just keeps changing. So where are the gains? Well, the gains are in these cracks in the market, and they're happening very quickly. The new normal, what I call the new normal, is that the profit taking has accelerated. That's why the market keeps flipping back and forth, because the big players, the big volume institutional traders, as soon as the market goes up, they sell. As soon as the market goes down, they buy at a bargain. So they're flipping the market back and forth on us every couple of days. The gains are in the short term. Again, we just saw the longest run is about 4 days. I think, oh, maybe there's one 5-day run there. But basically, they're in the very short term, just a couple days. And the gains are modest. The reason the gains are modest is because the bias keeps changing every couple of days. There's no time really for run-ups in the general market and in most individual stocks as well. Because again, even the hot stocks, they get caught up in the overall trend of the big tide of the overall market. Now, here's another difference between the old market and the new market. The average hold in 1960 was 8 years. The average hold today is 5 days. So what's the lesson here? And this is the lesson, this is the big lesson of today's class. And that is, the faster you cycle through your trading account, the more opportunities you have to score trading gains. Let's look at a real simple example. We're going to keep the math really simple today. If you do a weekly cycle, if you trade every Monday and sell on Friday, and basically you do a 5-day hold and maybe you get a 1% gain on a trade. But if you do that every week, well, that's 1% gain a week, and you can get a 50% return a year. That's an awful lot better than what the S&P is doing. And the reason you're getting that is because you're cycling through your working capital on a weekly basis. Now, there's no rocket science here. This is how professionals trade. We all know it. They trade every day. They don't wait for a better day. They don't take the summer off. They don't sell in May and go away. But they do trade every day, and they look for realistic gains per trade. Again, as I just showed, the market is changing so quickly. Shooting for big gains is really kind of a waste of time. And pros don't chase large gains. They chase small moves every day. They get in and out quickly. They take their gains as soon as possible. And this is what we're going to talk about today. Here's an example of really why this method is so powerful. If you look at the crash, the big crash of 2008, 2009, the one that caught what I call casual investors, people sitting, in long-term positions or mutual funds, the crash of 2008, 2009 wiped out a lot of accounts, and it was devastating, no question about it. If you look at it on a weekly basis, as we just talked about, trading, on weekly trades, in Monday, out Friday, that kind of thing, crash was tough, but it wasn't devastating. You can see there were several weeks where you could actually make back your money, and these people who were in and out of the market on a weekly basis, on a short-term basis, typical swing trading, actually had opportunities to do okay. But if you look at what professional traders do, getting in and out daily, looking for daily opportunities, you see that in this terrible period, the worst trading of our lifetimes, there were 41 days up out of 105, 40% up days. I mean, it's not that far off of an even money 50-50 market. It's not that different from what we have now, where it's flipping back and forth. So the point is that even in a terrible situation like the crash, if you take a daily perspective on the market, if you engage daily, if you're always in there ready to pounce on opportunities, the fact is the opportunities are there and you can take them. And we all know that professional traders, their bonuses didn't really suffer all that much the year after the crash. And a lot of headlines about that. People were scratching their heads. This is why, because they were in and out during the crash, because the crash really wasn't a crash on a daily basis. There was a lot of volatility, there was an overall downward trend, but the fact is there were always upside opportunities happening in the cracks, what I call in the cracks of the market. So for short-term traders, what crash? There really was no crash. The lesson here is that we like small steps. As I said a minute ago, big gains are rare, especially in this market that's flipping every other day. Big gains are needle in a haystack, and the current market does not allow enough time for those big gains. You really can waste a lot of time just searching for the big fish. On the other hand, the small gains are always available, and there are small gains every day. We all know this. I mean, a lot of this is very simple. We all know there are small gains available every day. So I want to, big gains, I call trophy trading, to use a word that's in the news a lot right now with that guy in Africa and the lion. But the fact is that the media likes to talk about trophy trading. It's what we read about, the big gains, but they are rare, especially in this market. Small steps equal big gains, and now we want to talk about the mechanics of how that actually works. What really happens when you look to trade small gains, short holds, small positions? I call it baby step trading. And we also call it, actually in the office here, we have another name for it. We call it the quick cycle portfolio. This is a method that moves your money in and out of the market on a daily basis. You can use this with really a lot of different trading systems. As Jeff mentioned, we happen to use it with RMO, but there are many ways to use it. This scenario here, we'll just use a very average scenario, small trading account with 12,500 exposed at any one time, maybe there's $15,000 to $20,000 total capital to cover, settling and that kind of thing. But not a lot exposed at any one time. What happens is making trades on a Monday and taking basically an average 2-day hold and pulling out a small gain. For the sake of argument here, we put in 2.5%. Doing this, pulling out the money on a Wednesday on average. Same thing on Tuesday, same thing Wednesday. Always cycling your money in and out. The point here is that if you look at the money we're putting in the market, 5, it's $25,000. But as I said, the exposure is only an average of about 12,500. So you're basically cycling through your working capital. The capital that you can put to work, you're cycling through it twice in a week. That's working the money hard. It's working the money a lot harder than most traders do. And the beauty of this is that it allows modest gains to really add up. It increases potential for profit, and it lowers the risk of losing gains to the pullbacks because you're always in a state of getting liquid. You're always taking small positions, setting tight stops, and you're always taking money out. Every day you're taking money out. So you lower the risk of losing when the market does its corrections, which is basically correcting itself every few days. So here's a real simple example of how this works. $12,000 account, again, $12,500 exposed. Small positions, as I said, $2,000 buying orders. Let's say you do 4 signals a day. You have a system, and 3 of those execute. So you put in $6,000 on a daily basis. You have a sort of an average kind of a system where you get 60% wins, 2/3 win, 2 win, 1 loss. You'll make 3% gain on the winners. That comes out to $100. Setting a tight stop is a key to this method. 1 loss, always setting around a 1% stop loss to curtail the losses. What you get here, you can see $100 on the wins and $30 on the loss. You're netting $70 a day, which doesn't sound like much, but as on a weekly and then on a yearly basis, it really adds up, and it can add up to triple-digit basically returns, more than doubling the money of the original working capital. That's the beauty of this kind of a method. There's nothing outrageous here. You see, we're looking at small gains per trade. We're looking at small positions. We're not going after big fish. We're not looking for those stocks, those needles in a haystack that are supposed to take off but never do. This is about just going out there, doing your job, making a few good trades every day, and cashing them in very quickly. It's kind of like building a brick wall. You start out building a brick wall. It takes you a whole week to lay the first course of bricks, and your wall is about 6 inches high. But you do that every week, and at the end of the month, your wall is it's maybe 4 feet high. But at the end of the year, your wall is like 30 feet high, and it's impenetrable. That's what this is like. It's every day going out and trading, every day going out and laying a brick and creating wealth on a yearly basis. Now, as I just mentioned, stops are essential in this kind of a method because you're trading a lot. So a lot of people don't trade like this because they get scared. 8 to 10 trades per week, it scares a lot of people. But tight trailing stops are the key, and some people say that's a really tight stop. Well, the point is when you're trading a lot, you set the tight stops, you take your losses, you suck it up, take the losses, move on to the next trade, and this prevents you from actually losing money and letting the gains overpower the losses. Let's say you take 30 trades a month with the 1% trailing stops, and let's say you have a terrible system. It's basically your system only gives you 50%. It's just as good as throwing darts. It's just as good as flipping coins. I would say that's a pretty bad trading system. Most people have a much better trading system, but worst case, you might be down 15%. On the other hand, almost any system is going to get you more than 1% per winning trade. That's not hard to do at all with all the great systems that are out there. So you can see if you have 15 losing trades and you lose 15%, but you have 15 winning trades and you're doing a little bit better than 1%, you're actually going to come out ahead. It's not that hard to come out ahead. This is a safety and numbers play. This is why professionals trade like this, and this is why we urge individuals to take a look at this type of methodology. Continuity is essential, though. The gains are in the numbers. If you don't trade constantly, you can't get the gains. In other words, if you say, well, I'm only going to trade like this, a couple days a week. Well, see, then it starts to not become worth it. because the fact is making only $50, $70 a day, $100 a day, it's just not a lot, not a lot of juice there to keep your interest in trading. So just as stops are essential to curtail the losses, continuity, getting out there and trading every day is also essential because the gains are in the numbers. This is a volume play. Now, to make this work, there is one thing you do need, and you need the right kind of signals. We call them quick cycle portfolio signals. They have to move quickly. They have to be signals that move, basically tomorrow if you're using an end-of-day system. You're not going to want to sit around. You want to hold the trade only for 1, 2, 3 days, maybe 4 days tops. They have to move enough to make it worthwhile to trade. They have to be fairly accurate, but as we just showed, anything over 50% is good. But the more accurate, the better. And they have to generate enough trades because continuity, again, is essential. You've got to get signals every day. You can't use a system where you're only getting signals, 3 times a month, because there again, that's more like trophy trading, and it's just not going to add up. It's not like laying bricks in the wall. So we use a system that's powered by MetaStock. We call it the green light system. The average hold is 1.9 days actually right now, and the gains are modest. I mean, they're 3.3% per winning trade. But again, we've just showed how they really stack up to double-digit days. It's because of this mechanical, constant, quick cycle method. And this is what we're getting in Q1 and Q2 of 2015. What we do is we squeeze RMO. We use the RMO indicator in MetaStock, and we also use the Wilder indices to produce 2-day trend signals. We put the two together, and I'll just show you a couple trades that basically all look kind of the same. Here's one from just a few days ago, EDZ. It's actually a bear. It's an inverse ETF, and we've had some great trades in this market on the bear ETFs. I like to call them bear funds. The signal is the day before, target entry the next day, and this is, you can see, it's 1, 2, 3 days, bing, we go in on the second day, we're out on the third day, we had a 9% gain. This is very typical of the kind of signal that Greenlight and with the RMO, what I call the squeezed RMO produces. You can see there's really nothing going on here, and the trend ended very quickly. The system identifies exactly this kind of trade. Here's another one from a few days before that, Lilly. We got the signal on the 7/22 the night before, 1, 2, 3 days. Third day, it's up 3.5%. A very typical green light trade. This is a small cap, a Boyd Gaming from a few days before that on the 10th of July. Here again, you can see kind of flat going in, kind of flat going out. This was a long one for us. 4 days, signal the night before, 1, 2, 3, 4, 9, basically a 9% trade, and out. So this is what the signals, why the signals are important. They have to signal trades like this. This is what green light signals. It adds up to much better than the S&P all year. You can see we've been basically having multiples against the S&P, and basically on a continuous basis, starting with 12,500, using that same illustration as before. By the end of June, the system was up 82%, which is a lot better than 2% for the S&P. We do sell the strategy at our website. It's $289. We teach the whole method of using RMO with the Wilder indices. You get full instructions. We have a scan room to help you learn it. You make sure you actually learn what we're teaching. Get 1 month free daily signals, and if you don't have MetaStock already, Jeff has agreed to give a free month to new customers of MetaStock as well. It's all available on a 5-day risk-free examination, and everything is available at steadytrader.com, our website. So if you want to take a look at the system, the strategy or the signals, they're right there, Greenlight Trades at Steady Trader. To get a free copy of the book, again, I'm going to make this easy. Just go to steadytrader.com. You can download the book for free. It's called Read This First Before You Buy Stock. And if you have questions, please shoot me an email at steadytrader.com, or you can call the number here on the screen. I'll leave it up for a minute. Also, if you're interested, I have an Excel spreadsheet I can send you on the quick cycle portfolio. I can shoot you that via email to show you another example in Excel of how this kind of mechanical, kind of fast trading approach really adds up on a mathematical and arithmetic basis. So again, everything is available at our website, steadytrader.com. We are steadytrader.com. There's another guy out there who calls himself the Steady Trader. We're not him. We are steadytrader.com. My name is Roy Swanson. Once again, I want to thank everyone for coming, and turn it back over to Jeff. Well, it seems like we may have lost Jeff Gibby. So again, this is Roy, and I just want to thank everyone for coming.
Just momentarily, I dropped connection.
Okay.
Can you hear me, Roy?
Yeah, I handed it over to you,
No,
but
I
there
was
was
telling
no
you.
one there. It took me a while to figure out you weren't there.
All right. Well, yeah, I was GoTo crashed again, so I don't know. I'm having some compatibility issues or something.
I didn't know if I crashed or you crashed. Just talking into the void here.
Okay. So where did you leave off?
I finished. I'm.
All right. Cool.
Thanked everyone for coming, and I just attempting to hand it back to you, Jeff.
All right, very good. Well, I appreciate your coming. I'm sure the last 10 minutes were as good as the first 20 minutes. And thanks for coming in, everybody. And we do have a question. Tom asks, can you expand on the connection between RMO and Wells Wilder?
Well, that's what we actually teach in the strategy. So we use the two together, and as I mentioned during the presentation, we use some of the Wilder indices to actually squeeze RMO, because RMO in itself doesn't give you the kind of signal that we're looking for to do these, essentially these average 2-day holds.
All right.
So it's a question of corresponding indices.
Cool.
In fact, we're also using we just started using a third one on MetaStock that's helping out a little bit too. So but it's all just out of the box MetaStock. MetaStock indices right off of the power panel, the power console.
All right. Well, thank you, Roy. Thanks for everyone for coming. Trevor asks, can you use this for the options trading?
I think it does work for options trading, especially weekly options trading and the timeline. We don't do it. I have no research on options trading, so I think it would be up to you to explore. But I see no reason why it wouldn't work for options.
Cool. Okay. Well, thanks, Roy. Sorry about the rough ending there. I didn't mean to leave you on your own. But we appreciate you having me here, and thanks to everybody for coming today. I really appreciate it.
Yes, me too. Thanks again. Thanks for having me, Jeff.
We'll see you at the next one, guys.
Take it easy.